Hey, what's up, stock compounders? Brad here. So today I want to talk a little bit about stock market psychology. It's something I was planning on making a video about today anyway, and I just got a comment from family dinner about it. So I just want to read, there's a Peter Lynch quote in this comment, and it's very relevant to what I wanted to talk about today. So Peter Lynch says, "This is the problem that people have is they sell stocks because they don't know why they bought it. Then it went down and they don't know what to do now. Do you flip a coin? Do you walk around the block? Do you know what to do? I've tried prayer. That hasn't worked. So if you don't understand the company, this is the problem when they go down," right? So then he says, so you better fully understand the business if you're going to buy it. This is one downside of mindless cloning. It's really scary when a stock price starts to drop. So let's talk a little bit about that today. I want to speak specifically to the idea of cloning. So say you're following a super investor or whoever it is, they've got a great track record, and you believe that you can outperform the market simply by copying their buy and sell decisions. The problem we run into as investors, as humans, is when stock prices start to move either direction, up or down, we interpret that as meaning something about the business, about our investment. The truth of the matter here is that in the short term, stock prices don't necessarily have anything to do with what's happening with the business, okay? Could just be human psychology that's acting on that stock, whether people are flocking to it for whatever reason or they're running away from it. It doesn't necessarily have to do with the business itself. So, I want to talk about anchoring, which is something that I've done on numerous occasions. I'm probably doing it now with a few stocks. And the other, right, looking for price movements as confirmation. So anchoring, the issue I have with anchoring, say I buy in a stock, let's take an actual example, Micron. So I bought into Micron at $34 per share. I think it's trading around 45 now. The issue I have is that because I bought at 34, there's something in my wiring that almost makes me feel entitled to buy at 34. Like if I can't buy as low as 34, I'm just not going to buy because I've tasted $34 per share before. So the issue with that is at $45, Micron might be a better investment than any other opportunities that I have right now. And the way to judge that is really based on the underlying value of Micron. What is a share worth as compared to what the price is? Not comparing the price today to the price I paid for it. And it's so easy to do that. I do it all the time. So I'm trying to train myself. That's not a very effective or rational way to invest, to anchor to my original purchase price. So that's anchoring. Coming at it with fresh eyes. Okay, what is this stock worth? What is the price today? Do I like that deal? Right? Forgetting about what I've done in the past with the stock. The second thing, when the price goes up, right? So let's take Seritage Growth Properties, for example. So I bought in at around $10 per share to Seritage. It's somewhere around 16 now, okay? Which is great return in a couple months. The problem is, it's so easy to look at that 10 to 16 jump as confirmation that, hey, this must be a great company. This must be a great investment, right? And I've seen it in some of the comments, like, people are saying, if it goes back down to $7 or $5 per share, they're going to back up the truck. But I can remember I was looking at Uber, within the last year, I think in March. And Uber, I was like, okay, I'm going to buy some Uber if it gets down to 24. Uber basically went straight down to 15, okay? And I didn't buy any. Because when the price is dropping, you've really got to understand you're going to have a totally different psychology. You're going to feel totally different about that stock than if it's just gone up 50% or 100%. So it's very easy to say things like, hey, if it drops a lot, I'm going to load up on this thing. It's easy to say that when it's gone up recently because you're feeling good about the company. You're feeling good about your investment decision. And so this is the danger, looking at short-term price movements as, looking at Mr. Market, what Mr. Market is telling us as wisdom, okay? Mr. Market doesn't have any wisdom in the short term, all right? Mr. Market has wisdom over 2, 3, 5, 10 years. Usually Mr. Market gets it right if there's a discrepancy between price and value over those longer time horizons. He is not good at getting it right in the short term. Benjamin Graham called Mr. Market manic depressive, okay? You don't go into business with a manic depressive. You don't take advice on what to do with your investments from this manic depressive, okay? So I need to drill that lesson into my head. Same thing when the price goes down. It's so easy to look at, especially if you don't know about the company, right? Back to this shameless cloning situation. If you don't know much about the company, if the price goes down, you're going to be sweating. You're going to be losing sleep if you have a meaningful stake in that company. Because you're going to think, oh man, I made a mistake here. Clearly, this company isn't worth anything. Like, look, it just keeps on going down. If we don't have a sense of what the business is worth, the most we know about what's happening is the price movements. That's our compass at that point. If we don't know what the underlying value is, all we have is the price fluctuations. And so when the price goes down, most people are just going to sell, right? And they're going to lock in a loss, and it's going to be very discouraging. So in order to deal with that as a shameless cloner, if you're a lazy investor, if you don't have the time, and I'm not saying that disparagingly, more power to you if you're a lazy investor and you want to try to beat the market by, cloning fantastic investors or, any of those strategies I mentioned in a recent video about how lazy investors might be able to beat the market. I have no problem with that. But what you have to do, you have to remove your emotional decision making from the process of investing, okay? Because if you allow yourself to have some leeway about what you're buying and selling, when you're buying and selling, you're going to be your own worst enemy because your emotions are going to be driving that decision making. So if you're doing the shameless cloning approach, which I think can be a fantastic approach if you do it in a thoughtful way and you set up rules for doing it that make sense, it's really important if you're doing it that way and you don't really understand the business that you own, you don't understand the investment thesis of the business, you've got to have kind of a mechanical approach for buying and selling, okay? Great advice. If you're cloning someone, great, you buy when you see that they've bought, when it's disclosed in 13F filings or wherever you're getting your information that they've bought, so you buy. You've got to clearly define when you're going to sell, okay? Seems like a smart way to do that is to wait until it's publicly known that super investor has sold through 13F filings. There was a study done about cloning Warren Buffett. It was a paper written by two professors in 2008. And it's called Imitation is the Sincerest Form of Flattery. And, you know, they went back through what Buffett bought and sold for 30 years between 1977 and 2007. And if you had simply bought, so you bought what Buffett bought at the end of the month that it was disclosed that he bought. So, you know, we find out what investors have bought and sold in the last quarter, you know, 45 days after the end of that quarter. So for the first quarter, say it's mid-May, right? So the way that this study was set up, if Buffett bought something in the first quarter, you would wait till the end of May, okay, the last day of May, to buy into that position. And then when it was publicly known that he sold, you would wait till the last day of the month when it was disclosed that he had sold. And if you had just done that with Buffett over those 30 years, you'd have like 20% annual returns versus 10%, give or take, for the S&P 500. You're basically doubling the return of the market just by mechanically buying and selling based on those 13F filings. So you don't need to have that mechanical approach, but you need to protect yourself from being influenced by short-term price fluctuations, okay? That's the biggest thing. You can't, because they are going to impact you if you don't have a plan in place in order to mechanically do these transactions, okay? You have to protect yourself from your own emotions. I mean, that's really the reason that even people who index, even people who buy the S&P 500 underperform the market, because they buy more as the index rises. As the stock market is going up, they deploy more capital into their passive investing approach. And as the market is dropping, they either put less in or they take money out, okay? When at the time when they should really be putting it in. So following our emotions, in the vast majority of cases with investing, causes us to make the wrong decisions at the wrong times. So, you know, you just need to understand that as an investor, regardless of the approach you're taking. You have to understand how you can be your own worst enemy and understand what those decisions are and avoid making those emotional investing decisions. So that's all I wanted to share, guys. Just wanted to get into the emotional kind of psychology aspect of investing. I think it's not talked about enough. It's really important. And for myself, I want to really keep a close eye on this idea of anchoring and making sure, you know, I'm kind of forgetting what's happened in the past and I'm looking at value today compared to the stock price today and making decisions based on that situation. And, you know, removing any of those biases that really aren't helping my investing portfolio. So that's all I got for today, guys. Let me know what you think of anchoring and letting price fluctuations in the stock market kind of influence your buying and selling decisions. Curious to hear from you on that. All right, guys, that's all I got. I will see you in the next video. Take care.